Investment in securities market are subject to market risks. Read all the related documents carefully before investing.
I got a eureka moment with options in 2017, just by mistake, just by pure mistake. Obviously, I lost money. It was at least 6 figures easily. Whatever I'm telling in terms of the dollars.
You do US trading only. Do you have the same concept where you give the
99% of my portfolio is in options. People say that it is extremely risky.
Suppose we execute multiple put contracts and the market falls by 10%.
There are 2 more strategies that I want to talk.
How do I decide? Is it going to be 1:2, 1:3, 1:4, 1:10? There has to be some method, right?
My only goal is to get more premium, no matter with keeping the same risk in control.
In India, implied volatility in put option is always higher than in call option. So how is the case in US? Hello traders, welcome to another Face2Face Trading. I've been trying my best to give you access to some really genuinely good people whose life is dependent on trading, right? Maybe people from India, maybe people from US or Europe or wherever. And my quest of finding or discovering right talent is always there. I have 2 agenda when I do this. One is obviously my own learning and betterment of my own trading style. And secondly, because I'm now committed to you that I will give you the right people, it's like a constant journey of empowering all of you. Today, in this face-to-face, I have an Indian who used to work in US in Citibank. He then became a full-time trader. As an option seller, he has succeeded in last 4 to 5 years and already created a hedge fund. And he's on the path to become one of the largest in that domain. So someone who started with buy and hold, sold everything, and now became an option seller and doing things exactly the way it should be done. So if you are looking forward to a long-term money making or wealth creation using options trading, I think this could be an interesting video for you. I was very enlightened by this particular video I just completed. And I must say, this is one video which you should see till the end, and also make sure you share with your friends and family. Thank you so much for being part of my family. Now let's welcome our friend from US, Mr. Naresh. Hello, Naresh. Welcome to Face2Face.
Hello, sir. How are you? Glad to be here.
Fantastic. I'm very happy. Very excited for this one. You have made all of us proud. From India, you are in US. You have worked in US as a corporate executive in multinational firm. You decided to become a full-time trader. You have been a successful full-time trader. And now you are a hedge fund manager as well, managing large capital for other people. So this is like a dream profile, especially for face-to-face. So I'm very excited to record this one. Thank you.
I'm very much excited as well, sir. I've seen a number of your videos and, love to be part of this journey.
Thank you. So Naresh, I've gave a very bird's-eye view about your career, but we definitely want to know more about you, purely for the purpose of getting a lot of inspirations from you, because my learners, they're hungry for inspiration and you are one of them who can inspire them. So please tell us everything about you. First, you went to US from India. What was the trigger point, and what made you believe that you can become a full-time trader?
Yeah. So I did my bachelor's from Usmania University from 1996 to 2000 in chemical engineering. I did in the campus. It's not an affiliated or something. I did it in the Usmania University.
Okay.
So I have a heavy math background. Right from the MSET, just like writing SAT score, like in 96, right? You write these entrance exams like IIT, and I did not appear in IIT, knowingly that I cannot, get a score, because I was very clear that my talent is in the MSET, where I could pursue my dreams, within that frame.
Okay.
So I got a 576 rank in MSET out of like 100,000 people.
Mm-hmm.
I selected the chemical engineering because it was part of a campus. I did my bachelor's from 96 to 2000.
Mm-hmm.
Once I graduated, I came to US to pursue my master's degree.
Mm-hmm.
The only reason why I came to US was we had no opportunities at that time. meaning I was given a job in Oracle, if I remember correctly, for like 96,000 per annum. We had to stay there for like 2 years with keeping our passports and everything, and that was the only opportunity. But right now the things have changed, dramatically changed.
Mhm.
So my goal was to do a higher education. I came to US in 2001.
Okay.
I did my master's from New Jersey Institute of Technology in computer science from 2001 to 2003. I wanted to do a math PhD because of my background, because for me, all the world is numbers, nothing else. Everything I look at it is numbers. So I applied for PhD. I got admitted into PhD, but fortunately or unfortunately, I got a job in Citibank. That was in June 2003. It's once I took the job, I worked in the corporate for 19 years without a change. It was a one simple job, and day in day out, I did increase in my career portfolio, up and down. I got a eureka moment with options in 2017. Just by mistake, just by pure mistake. And along this journey, I was always a buy and hold guy, meaning, you buy the Apple, you buy the Netflix, at a very low price, you kept it for 10 years. You saw this growth every single time, right? But in 2017, I came to know about options. And I obviously, I got excited. Then I started buying options in the assumption that something will go up or go down. Obviously I lost money. Like 17, 18, 19, I lost money. It was at least six figures easily. Whatever I'm telling in terms of the dollars, okay, like close to 100,000. The money was, I will not say an issue, but we were earning, right? I mean, me and my wife were earning. I was thinking that I was putting this as a cost of education, meaning you have to pay something to achieve something, right?
Yeah.
So in 19, I was thinking, this was before COVID, right? And so mid 19, I was thinking, I am always on the wrong side of equation. Why am I in the wrong side of equation? Because you see all these Twitter posts, YouTube, these, that. I mean, why can't I become like opposite side, right? Meaning, why can't I become a seller? Why should I be buying? Okay. Then I started venturing the YouTube content, learned heavily about options, and learned about all this terminology, then started selling the put selling. That was my first idea, how to gain money. And that's it. I never looked back after that. I mean, I became consistently profitable from June 2021, meaning in the last 55 months, I had 4 losing months.
Wow.
Yeah. Wow. And every single month I'm able to produce like 1-2%. Along this journey, I used to give a lot of Zoom sessions to people just to educate them about put selling. This was in the COVID time, because we had a lot of time. There is nothing to do, right? So I started giving these Zoom sessions, and believe it or not, one of the good friends told me, Naresh, you have this much knowledge. I mean, I don't want you to go to waste. What he gave some kind of, I consider that person as my mentor, meaning he's like a guy who pushes you to achieve some good things, right? And he told me, I don't want you to end up like a teacher. I mean, all the teachers will have a Nobel prizes, big things on the wall. I don't want you to become that. I mean, I want you to earn money so that it changes your life. Then you come back to the world, and so that you can manage our money also. That was his thing. So I was completely gone, into the shadows for 2 years. I didn't do it. No appearances anywhere, because I was constantly wanted to make like a consistency. That's when the 2023 came. Then 2023, I started managing other people's money via SMA route. It's like a separately managed accounts. So basically, what would happen is you will have a parent account, and all the kids, child accounts, you will associate to that. Whatever the parent does, depending on their net link, you get number of contacts will be distributed. I did that for 6 months. It became too much. Then obviously I had to open a hedge fund to the bigger world. Basically, that's my journey.
Lovely. What a beautiful journey you have. I mean, it's an options trading journey for not many years. I mean, and in these 4 years, you have scaled up so much. I mean, you were showing me your capital base and how much you have generated return. That is incredible. I mean, congratulations for this. And I wish
Thank you.
all of your
I'm
investors.
always a learning, sir. I mean,
Yeah.
I have to say this. Even today, I watch like 2 hours of podcast. I'm a visual learner, basically,
Yeah.
meaning I speak to a lot of people just like that. I mean, if I want to get in touch with somebody, I will patiently wait for that person to respond, because once we, if the energy is like kinetic, right, between the two
Yeah.
people,
Yeah.
and it definitely brings good out of both of them. So
Yeah, that's why probably we connected so well.
yes, sir.
Similar thought process. So, Naresh, your buy and hold portfolio that you have been running for many years now, and that must have given you certain CAGR. And option strategy, the selling piece particularly, it has given you a CAGR. Both has obviously huge difference.
Right.
Mike, I have two questions. What is the multiplier difference? You may not share me
Yeah.
the exact number, but at least a multiplier difference if you can share me. And number two, for option selling in US, because you do US trading only, do you have the same concept where you give the shares as a margin and then you get the exposure in options?
No, sir. So the first one I want to answer, right? When you start small, let's say, as I said, I'm talking in terms of the dollars. Let's say you start small. Like we have a concept of 25,000. If you have above 25,000, the PDT rule is not applied. PDT is like pattern day trading, where if you have less than $25,000, you can only do 3 trades per week.
Okay.
If you start like about 25,000, you can do any number of trades, right? The problem is losing 50,000. It's not a big deal. I mean, it's a big number, but it's not a big deal. But you can scale it up like 50,000 to 60, 60 to 100. It's okay. But let's say when you go to 7 figures, right? Let's say $1 million, right? You will be cautious not to lose more.
Yeah.
When Trump announced tariffs in US, market got panicked and the market dropped 17% down. But I was up like 6% within the same time frame.
Okay.
The people with big portfolios, they don't want to lose money. They
Uh-huh.
want to accumulate the capital and CAGR in a slower fashion, right? So, for example, right, I have exactly the same topic in one of my slides, like why it makes sense to be consistent, like a slow rabbit step, like as opposed to running like a cheetah, like doing like 50-60% year. It makes no sense. You have to have lower drawdowns, at the same time have a positive expectations about the market. So that's what is number one. Number two, in US we don't have a concept of giving shares as a collateral. So I have no shares in my portfolio.
Oh, you sold everything. The buy and hold.
I sold everything. I have nothing left. I only trade one ticker, which is the S&P 500. But within the portfolio, within the hedge funds, we have to do a lot of tickers. There is a reason behind it, meaning we have to acquire the CAGR slowly and steadily across all the asset classes. The reason is simple, meaning let's say if Apple is doing good, it is not necessarily that Nvidia will also do better. PLTR could be doing something else, and the Netflix could be doing something else. Meta could be doing something else. So the strategies that I'm going to deploy, that I'm going to explain, will have different asset classes. Why one should have you cannot trade a strangle on a Tesla because it makes no sense. It's going to breach one of the side easily. You don't want to touch it. So Meta is a pure covered call strategy. I'm going to talk about those things in my slides. So we have a margin. Basically, the broker will give you 2x margin, 4x margin, or 7x margin, depending on what kind of an account you have. Retirement accounts will not have any kind of a margin because retirements are supposed to be kept safe. But I'm 99% of my portfolio is in options, and people say that it is extremely risky, and I don't deny that.
Okay.
But if you know the probabilities, if you know what you're doing, even in a complex strategies, there is a hedge we can find that edge. My job as a portfolio manager and as a hedge fund manager is spend the time, find those strategies that have a positive hedge over the long period of time with a minimal drawdown. So when I say long period of time, I'm not talking about one day. I'm not talking about 1 week. I'm talking about 100 consecutive days.
Yeah.
If I do the same strategy using the same set of principles, can we generate the positive alpha with lower drawdowns? That's my goal. That's why I spend my time at least back testing an hour and at least 2 hours of podcast. Anything that fascinates me, I would love to watch.
So great, Naresh. Let's do a screen sharing. I'm sure this podcast will also be superly knowledgeable for a lot of people. They'll watch this again and again. So let's do the screen sharing. You have made a beautiful presentation for us. So, and please pardon me if I keep on asking you basic questions again and again.
Please, sir, you can stop me in between. And, if you have any questions in between, we can always come back to it. Let me share my screen.
Yeah.
Yeah, please let me know if you can see my screen, please.
Yeah, I can see the screen.
Okay, nice. Okay, perfect. Okay. So the topic of discussion is how do we create long-term wealth using options?
Yep.
As I mentioned, everybody definitely thinks that options are extremely risky, which they are. But as long as you know some of the basic things,
Yep.
and if you can keep it simple, it will make life easier, right? I mean, this is about my bio.
Yeah.
Right. We spoke about this, and a couple of basic rules, right? Basic rules for trading. Even before you enter the trade, the decisions have to be made pre-trade, not while the trade is running, and definitely not when it is going against you. So that's number one. What does it mean, right? So let's say you are getting some kind of a put selling, some kind of a strategy that you're doing. You got like $100 credit. Now the decision to get $100 is yours, but when are you going to cut the losses and when are you going to take the profits? Those decisions have to be made before, not when you enter the trade. And never adjust any trade. It makes absolutely no sense, because your definition of entering, which means that you entered based on certain parameters. Once the trade is against you, you don't want to work, to do any kind of adjustments. Either you have to cut the losses, because as I said, you are making these decisions ahead of the time. I will help along the way, what kind of decisions those will be.
Yeah.
And always never deviate, right? And absolutely, you should always have some kind of a 2 to 3% max loss on an entire portfolio in a given day, because things will change dramatically. The technical analysis only works, in a trendy markets up or down, but any kind of a news like, which we cannot control. Always diversify your strategies, which means you should have some kind of an idea that, these stocks are going up, these stocks are going down, these will stay in the neutral. And for these things, you have to have all those strategies lined up. I can explain what kind of strategies that we are, talking about, right? We are here as a trader. We are here to control the risk. What does it mean, right? I mean, you're not playing this, this for me, this is just like a game, right? I mean, two people are playing heads or tails games, and, I want to find a hedge where I will always get a heads, so that I'll win more money in terms of like, the CAGR. Now, psychology side, right? I mean, this is the most important thing. I mean, you can have 100 different strategies, but you have to have a very heavy mindset. As I said, when you start with a small capital, this may not apply, but once the capital grows bigger and bigger, managing that kind of psychology makes a lot of sense. Because a lot of times what happens is when a big loss happens to me, I keep thinking, oh, we could have bought a Ferrari or something like that, or a Rolex. But you have to keep, you have to always think in terms of the percentages, not in terms of the dollar figures, right? And always remember, market is never wrong. Whatever the market is doing, you are not there to double guess or anything, but always respect the market decisions, whatever it's doing, right? And when you do some of these strategies, you don't need to know what the market is going to do next. Meaning, you're expecting that market to do this way, but it never happens. It's always like does something else. You have to always think in that angle. And remember, market is it's a probability game. Options itself are like derivatives of stocks, which are like a completely probability game. Meaning, when you sell, let's say 30 delta call, that means you have a 70% chance to win, because we're exactly thinking opposite side. The same thing goes for the put selling. If you're selling one standard deviation put, which means that you have a 83% chance of winning that, right? You have to know these probabilities. We will never, we will always be not right. Sometimes there are times will come where we may be wrong also, right? You have to be ready for all of those things, right? And when do you become successful with respect to options trading, right? You will write all the rules, you will create all of those things, but if you don't follow them, there is no point in doing any of these. This is just a business, right? I mean, we have to pay certain prices. Sometimes the losses will come through, which is absolutely okay and acceptable, right? Trading is simple as long as you keep it simple. I learned this from your podcast, sir.
Okay.
Somebody mentioned KISS, if you remember, keep it simple and
Yeah.
safe. So, trading is simple as long as you keep your mind and, the views in perspective, right? Now, the last quote, this was by a Bruce Lee. I fear not the man who practiced 10,000 kicks once, but I fear that person who practices that one kick 10,000 times. The reason is, with that one kick, he can kill the opponent with simple. So this applies in trading also. When you start your trading journey, you have to be an expert in one strategy first, and my honest suggestion is the put selling. It is the easiest strategy where you can understand, and where you can understand the deltas, what you're doing, why you are doing. If you can master that, then automatically everything else will follow through. Because see, options is, there are only two things, right? I mean, like I say four things: buying a put, buying a call, selling a put, selling a call. That's it. Buying side, we are not doing it. We are only talking about selling side. So selling a put, selling a call. So if you can understand what is a selling put means and selling a call means thoroughly, like, without any questions, then rest of the strategies will follow through to understand, right?
Naresh,
Sir, my question to you, right?
There's just a couple of things. I mean, I'll keep on bothering you in the middle. Please don't
Sure,
mind.
sure.
Because I'm here in Indian market and you are trading US market, so we can do a lot of cross-sectional discussion. Because there are some things which could be peculiar for US market and some things which could be given norms in Indian market. Like for example, you just mentioned that selling put. Now in India, selling put is always considered to be very high risk because the scare of market going down is far bigger than the euphoria of market going up. So typical thought process is that selling a call option is more stable because market tends to behave in a linear fashion when it goes up, but market will fall very acutely if market goes down. And selling a put could be a very high risk event. So how do you combat that thought process?
Selling a put as a max loss of whatever you're selling the strike. Let's say you're selling 180 call. The max loss is 18,000. But selling a call has unlimited risk. It can pierce through with a single tweet and, like 10% up. It's exactly opposite thinking. At least, in my journey, selling a put is extremely safe because you have a downside risk is limited. Meaning if you sell it in a S&P 500 where all the 500 indexes are going to zero, the max loss is like 500,000. But the chance of that happening is almost zero. But selling a call, it can pierce through your strike, and you will be obligated to honor.
Oh, that's an interesting perspective. Actually, market can go up, sky is the limit, but when market goes down, the floor is always there. Interesting.
Floor is always zero. Yeah, and we are not there watching when the market is going to go down to those levels. Sometimes the overnight gap can happen, and we can protect it with some couple of hedges that I plan to mention. Yes.
Sure. Okay, sir. Let's continue.
So one question, I mean, sir, which trading system is better? Let's say you have two strategies running, right? I mean, I'm just asking which trading system is better, and if you notice, both have performed exactly same within the same time frame. So which trading system is better?
The one with lesser volatility and drawdown, maybe the one with the top.
Right. So why can't we combine both?
Okay.
If you combine both, you are going to get the middle one where the volatility is reduced, and you still achieved the same thing with a lesser drawdown. And so the reason why I'm mentioning this is you cannot be married to one strategy. You have to have a combination of few things working each in favor or each against. So that's this was one of the things that I want to mention. The second thing, right? I wanted to mention why consistency wins over time, right? So we have two traders here, trader A and trader B. Both started with 100,000, and over the 10 years, their average was 30% for the first trader, and the second trader also has an average of 30%. Meaning both, but the trader A seems to be a little bit consistent with all positive returns.
Yeah.
I mean, it may not be possible, but I'm talking about yearly fashion, right?
Yeah.
So, but some of the years he did only 12%, where this guy did 77, 57, 44, like big numbers, right? But if you really see what is their ending balance in 10 years is, the trader A did significantly like 500,000 more than trader B. The only reason is consistency is necessary. So why I'm mentioning this, right? When I say consistency, let's say if you're doing one strategy like a put selling or something, right? You cannot be married to one position, right? I will explain why you have to diversify within the same put selling and how it helps you, so that we can achieve the consistent results.
Okay.
Right. And so that's why, we have to be consistent. We have to have diversified strategies. And, now let's talk about selling a put. Obviously, this is on a margin, meaning it's not on a cash account. It has to be on a margin. I will give some examples.
Yeah.
So the first strategy is, we are going to go 90 days to expiration.
Okay.
Starting today, and you sell 15 delta put.
Okay.
And you get some credit and have a stop loss and a profit target. That's it. Done.
Okay.
We don't look back. Now, what is the benefits of doing this, right? So I took one of the snapshot, right?
Okay.
So I did. We are going to do the similar example. Even though market is closed, I think it's going to show some accurate buying powers, but we'll see. So for this particular trade, this is the 48 days to expiration. Credit received is $500. Buying power that the broker is asking is 3,825.
Okay.
If I do this trade and if I am successful, my return on capital is 13.07%.
Okay.
If I do the same strategy again and again for annually, my annual return is about 99%.
Okay.
Now, how am I getting the return on capital is basically the credit received by the buying power user, meaning how much collateral the broker is asking.
Absolutely.
And how do I get the annual? If I do the same thing, like 365 divided by 48 times what? So it's a basic math, right?
Yeah.
So, and this is such a simple thing to do. Right? Now, when do you do this strategy? Right? When you do a selling put strategy, you have to think it's certain like stocks that which are either they are staying at their levels or continuously goes up, like not continuously, like 2%, 1% here and there, like up and down, right?
Okay.
Because in selling puts, theta is our friend and we want to capture the theta, and we have 90 days to think about it, right?
Okay.
Let's say you put a trade today and market is continuously dropped like so heavily. Right. So heavily. So this becomes obviously the VIX will increase and, the credit will no longer be 500. You will get $750 or like $1,000. So because you have a stop loss setting set, you're going to take a loss and move on to the next one. Right. And going back to the consistency and doing again and again. Right. Now, I want to talk about how are the hedge funds do the same strategy within the same cycle. Right. So let's say we have 100,000 to begin with, right? So I'm going back to the same example. So let's assume that buying power is supposed to be like a 4,000.
Okay.
Right? What retail will do is he will go and sell 25 contracts by getting 25 times 500 in one shot.
Yeah.
Right. So it is not practical. If you think that way, it is definitely not practical, right?
Yeah.
So what the fund does is, you go back and analysis like we are doing 90 days to expiration, right? 90 days to expiration is 3 months. In 3 months, I have 4 times 3, 12 weeks, right? In 12 weeks, and I can do 25 lot contracts, right? Because, 100,000 by 4,000 close to, it's like I can do 25 lots, right?
Okay.
So within the 12 weeks, how many contracts I can sell each week so that I'm able to achieve the same goal? So what they will do is they will do the first week, they'll sell 2 contracts. They'll come back second week, they'll do a 2 contract. The third week, they'll do a 2 contract. Fourth week, they'll 2 contracts. And once the 13th week is over, they have a full book set, meaning,
Okay.
and all the Greeks are different, all the deltas are different, because the one that you sold in the first week, by the time it reaches the probably 7th or 8th week, this could have been almost near zero. You can
Right.
close it and reopen the second one. So that is, and let's say within the same time frame, if the market drops heavily, it is not necessarily that all these 13 positions will be stopped out quickly.
Yeah.
Maybe the initial ones are stopped out, but the rest of the stuff is not stopped out. As you can see, the retail will think to grab all the capital, all the credit available in one shot,
Yeah.
but the funds will start thinking, getting the same thing in a subsequent fashion, over the period of time, so that the risk is mitigated, the risk is diversified actually across all the within the same put selling, we are doing this in a systematic fashion.
So I'm just thinking aloud, sir. As I said, that because I come from Indian market, so I try to draw some analogies for Indian market. So we don't have 3-month contracts in stocks which are active. Typically in
Okay.
stocks we have monthly contracts. Okay.
Okay.
So how does that thought process change then? Suppose if someone wants
So
to do this.
yeah, basically this will change to 30 days to expiration.
Okay.
And the delta has to be a little bit bigger, like 30 delta or something, because at a 15 delta you may not have any credit available.
Okay.
So
when you say
within
15 delta, you're talking about that delta value of 0.15,
right.
Okay, great.
We can show some. Can you see my screen, please?
Yeah, I can see the screen. Yeah.
Right. So this is we'll talk about, let's say in the QQQ is like basically it is a tech stock index.
Okay.
It consists of like a combination of all the tech stocks.
Okay.
So as you can see, we have expirations, all the way till Jan 2028, like
Wow.
774. Right, you can see 774 days. Right, I mean, people will do trade that long. I mean, so within the time frame, let's say we are looking for the 30 days one, right? This has daily expiration, by the way. QQQ has a daily expiration.
Okay.
So January 26 is 39, Jan 9th is 32, maybe closer, or we'll do the Jan 2nd 25 days, right? So you come back to the 25, and we are looking for a delta, which is nothing but this is the delta.
Okay.
We're looking for a 15, like a 30 delta here. So 30 delta is basically this is the one, right?
Correct.
Right. So you sell, like, you are approximately getting $651 credit here for the strike of 611, right?
Okay.
These are the multiplies of 100. I don't know about Indian market, how the structure lies, but
the
multiplies are 100.
Different stocks will have different lot size.
Yeah, so we usually have, unless it's a futures, all the stock options are multiples of 100.
Okay.
Right. So 651 here. Let's make a note of a couple of things. We need a calci. I'm gonna open that calci. I'll tell why we need a calci.
Okay.
Right. So 611. I'm doing a preview. This is a 100,000 paper account. So if you remember, we got a $611 credit. Yeah. Divided by 82,000. So basically, approximately the broker wants 8,000 capital. Right. So we are getting like a 7.6 around that number, like right. We have to keep that in mind. Yeah. Then coming back, how much this will do? I have a calculator here. So this one, let's go back. We have 25 days, 611, 8,000. 25 days, we received 611, and we need 8,000 capital. Right. I mean, this is the this is the Excel that I built based on when I do take the trades. You need to be, you need to know what exactly you're doing, so that we don't need to do this calculation. So basically, what this is doing is, how many days to expiration is this? How much credit I'm getting? What is the buying power that broker is asking? What is the return on capital? 7.6. If I do this annually, I'm able to get 111. Yeah. Now I have a stop loss of 2x on this one. So basically, that's why my risk is, the 1,222, but my profit is about 611. Okay. Now, again, we have to think another thing. What is QQQ trading today? QQQ is trading 625, and we sold a 611 put divided by 625. So basically, this has to drop approximately 3%, so that our strike gets breached.
Okay.
right? And so you have to go back historically and say how many times that QQQ has breached 3% or more in the 1 month time period, because we are
Okay.
doing 1 month time frame.
Okay.
So you have a historical record, and based on the historical record, you will make this adjustments, and but you have a clear idea, right? This is, I'm getting 600 and, like, $51. The 8,000 is the buying power. If I do this consistently, I'll make about 100% over the time. But I'm also keeping a stop loss of 2x on this one, because if in case of market goes down heavily within the two, then I'm out. And if you do the same thing again tomorrow, the delta will completely change for this one. You will no longer get 611 strike, because for example, let's go for a week later, like
Okay.
611 strike. If I do the 611 strike, I'm getting now $800 as opposed to
Yeah.
611. Right.
Yeah.
So that's why, because within the 1 week, it must have decayed like a $200.
Yeah.
Instead of doing everything in one shot, if you do it consistently, you do one today, you do one tomorrow, or you come back next week. Like, if you can schedule it for 30 days, you have 4 weeks left, right? So 4 weeks is like 20 trading days, because Monday to Friday is 5 times 4. So you can do 25 contracts. So basically, you can do one lot per day on these 30 days within the same Indian market. But you need to, I'm unsure about the buying power requirements in back home, but it's the logic is same.
Yeah.
The logic remains the same.
Yeah, logic is the same. Just one quick question on this. Suppose we execute multiple put contracts and we have large position now, and suddenly some event happens because of which market falls by 10%. So obviously these are high beta, so they will fall
Right.
more than the market. So how do you manage the risk on that particular day?
So 7% is a threshold, meaning
Yeah.
if overnight 7%, if the market drops below 7%, there is a halt, basically complete halt. There is no such thing as going as 10%, because we are doing this on an index QQQ, and have I seen dropping more than 7% one time?
Okay.
That was in the COVID time.
Okay. Okay.
So we have a Discord group, like where the fellow traders keeps talking, just to engage, because the trading is such a boring job, right? You have nobody to pat on. There is nobody to tell you good job, bad job, this and that, right? So we have just a Zoom call, just casually to talk about, right? And believe it or not, I mean, I have seen some few Indian guys joined from India to trade US markets. So they keep telling that this is not structured market back home, because there is a lot of swings will come through, like you will see 10% drop, but a 10% drop on an index one day it's unless there is an event, like such a big event comes through, like a nuclear war, like some of those things, right? I mean, it will not happen. 3%, yes, absolutely, 3% in a day is possible. So when that happens, you are going to take a stop loss on all, like whatever the options you have, because if you have the capital, you can trade this back again.
Yeah.
If you don't have the capital, if you are married to one position and thinking that market is not going to drop, it's not, it's never like that. You always have to keep those probabilities in check, and
Okay. Question number 2, is this advisable to do in stock options, or I think you will prefer this to be done only in indices, because there the fall is much more calibrated.
Right. So if you know how the stock is behaving, see, for example, right, for me, the Netflix is the best, meaning to do a put selling, because it's always like continuously, goes up.
Yeah.
You have to know what, see, for example, there is a friend of mine who does these things in Wells Fargo, for example, right? He can read pattern that what the Wells Fargo can do. So for him, this is absolutely like a, amazing thing to do, because he knows market is going to go up, or Wells Fargo is not going to touch the 611 strike at all. So so you if you have some assumption that some of the stocks are going to go up or stable, where they are, absolutely, put selling is the way to go.
Okay. Quick question again. In India, implied volatility in put option is always higher than in call option, because as I said that in India we are more scared about market going down than comfortable about market going up. So how is the case in US? Do you see disparity?
No, it is the same thing, sir. It is the same thing. I
Oh,
mean, the
okay.
puts have, so we can go back and check, right? So this is 30 delta put. We got
Yeah,
like, $803, right?
yeah,
So let's go back the 30 delta here, right? I mean, you don't
yeah.
get that much. We get like 700 here.
So the implied volatility there is 16 in call option, and in put option, implied volatility of 30 delta was higher. So it's the same structure in US as well.
Right. Yes.
Okay.
Put side is always scary. You get more premium for the puts and, you
Oh.
can, yeah.
So can I presume that because you get more premium there, your ROE is slightly better, although the risk is high, and you are a mathematician, so you can calculate and evaluate risk quite well. So you want to play a bigger risk game.
Yeah. So these are all numbers.
Yeah.
Ultimately, honestly, see, I'll give you some example. End of the session, we discuss, we in the sense, me and my wife, right? She's is the heavy pusher for me.
Mm.
I met her in my bachelor's from Usman University. She is equally competitive, but again, the more corporate structure. When we discuss, I'll tell her, we made this money or we lost this money today. And her question is, what is S&P trading today? And my answer is, I don't know. I'm like, because I you have to forget, the
Yeah.
day is over, you're done. I mean,
Got it.
so
Super. So let's go back to the
So-
PPT.
yeah. So this is and within the same structure,
Yeah.
if you know very well that the stock is going to go up always, right? You can think of something like a jade laser, right? So for example, what is a jade laser, right? So what this does is you're getting $700 credit here, right? 750, like 770 credit, right?
Okay.
Now what if you go and sell a call credit spread which
Okay.
is the width of 500?
Okay.
So basically what would happen is, I mean, see, this is what the funds will start thinking. See, your idea is not changing, meaning your idea in the sense, like, you are still bullish on the stock. That's why you went ahead and did the like, put selling.
Yeah.
But you are also thinking that the stock is not going to go up more than 1% at all.
Yeah.
1%. So if you can gauge those things,
Okay.
I'm selling as I'm selling a put. I'm also selling a call credit spread. So basically,
Okay.
this is the 5 wide. The max loss on this is 500.
Okay. Okay.
But you have zero risk upside here. Meaning even if the QQQ goes like, let's say 650 here, meaning where the both strikes went in the money, you are losing 500, but you already got $1,000 credit here, like 995 credit.
Fair enough.
If you don't do this, you're getting 750 credit.
Fair enough.
Right? If the market stays above, you are going to keep all the credit for yourself. You don't need to do anything. Right?
Yeah.
But what I'm saying is, if I know that the QQQ is not going to gap up even like 1 more percent, what I'll do is I will go ahead and sell a call credit spread for $5, because even if it pierces through the 641, I get to keep the 988 minus 500, which is like I'll still be profitable 488. If market were to end, let's say 634, somewhere here 634 or 635, I will get to keep all the $1,000 from here.
Got it. And do you see an increase in exchange margin requirement because of this trade?
It doesn't. That's the beauty. That's why you're going on the other side. It's the same margin.
Oh.
It doesn't require extra margin. You're getting more credit, in fact. I mean, your margin will go down.
I don't think so. In India, they give so much of margin benefit because they'll consider this to be separate trade. And because you are selling put and buying put, yes, you will get some margin benefit because of that pair.
The extra credit, yes.
Yeah, some margin benefit, but your margin requirement in India will go up. Not as much as probably.
I heard about that, but I did not understand. Somebody was mentioning, one of the fellow trader, as I said, from India, he was mentioning at 22. I think I heard from your podcast also, like 22 lakh buying power required. Like, max loss is 22 lakh, but the broker wants 1.2 crores.
Yeah.
To that is I will say it's crazy. Meaning, if my max loss is 20 lakhs, why would they need 5 times more just to hold the position? I mean, but
India margining is slightly, in fact, it was very, very tough till 5-6 years ago. They liberalized it a bit, by giving you margin benefit if you buy another lot out of the money.
Right.
They have just
Right.
liberalized it a bit, but still it is far more tighter than probably I can see in US market.
Yeah, it's not like that. I mean, if you, but in US, it's not there. In Canada, yes, they consider both sides to be two different entities, and
Yeah.
they want both buying, but not in US,
Okay. That's
not
the
in
reason
US.
why we have liquidity in US. You are trading 3 years, 4 years contracts, and even in bad market condition or Six Sigma event, you still find liquidity. The problem is in India, if there is market goes down by say 2-3%, suddenly call buyer and put buyers are not there on the screen. So how do you square up? The impact cost is very high in India.
Yeah, those are definitely scary. Yes, those
Yeah.
are definitely scary.
But the liquidity is good in US market. In a high volatility, also you'll get call and put. The market makers are always active.
Yes, they are active. We will get the fills, but we may not get the good fills. I mean,
Yeah.
but we want to get out quickly in case of trouble.
Yeah.
Uh,
All right.
So that was the put selling. That's assuming the market is going to go up, right?
Yeah.
Now let's talk about what we already spoke about how the fund does. We already spoke about the Jade Lizard. Jade Lizard is like you using the same margin, you go on the opposite side, sell a call credit spread so that you get more credit and your upside risk almost becomes like a zero.
Yeah.
Now, assuming the market is going to go down, meaning when I say market, right, let's say a particular stock is going to go down.
Yeah.
For example, let's say there is an earning coming up,
Yeah.
like a PLTR earning, Palantir or like Nvidia earning is coming up, for example, right? So if the earning is coming up, if your fundamental analysis and all of those strategies are told you that the Nvidia is going to go down, it's simple to go on the call side and sell, a call credit spread and get the premium. But the twist here, right? I just want to, within the same reasoning, within the QQQ, remember my thoughts now is market is going to go down, right? So simple thing is like, sell a call credit spread, for example, something like this, and that entire money belongs to you.
Okay.
266. But what we can do like a twist is we can switch it. For example, right? I'm doing a buy here.
Okay.
Let's do something like 635 so that it's easier to, like a 35 to 40, it's easier.
Okay.
But I am, I'm buying one and I'm selling probably three.
Okay.
This way, what would happen is my thoughts remember my analysis here was the QQQ is going to go down, right?
Yeah.
If nothing happens, if the market, if the stock really goes down, I get to keep all the premium, like 1268 as is. If by mistake, if our analysis is wrong, for example, meaning it did opposite of something and it started going up, let's say it pierced through the 635.
Yeah.
You are still profitable up to 640.
Okay.
Because the 635, 640, this is the $5 wide credit spread.
Yeah.
You will still be making money.
Okay.
If it goes to 645, that's when you will start losing money.
Yeah.
Right. So, and we are giving enough time for the market to react. And remember the original goals, right? Even before entering the trade, I will decide when I'm going to cut losses without any hesitation, without any adjusting or anything. This is what is, when you know that market is going to go down, we should do the call credit spread or some kind of a ratio call spread that you get to more premium. And in the ratio spread, what would happen is even if the market is against you, you still make money.
Yeah.
Up to a certain point.
So when you're selling extra, like this is from 1:1, you have done 1:3. So because you are selling extra 2 call option, so your margin requirement will also go up, the buying power?
It will go up, and little bit. It will not be crazy, but we'll see if it doesn't allow. We have an idea. So as you can see, this takes about 17,000 credit. You can see this, as I said, this like 100,000 paper account, right? It takes about like a 17,000. Now come back here. Let's go back to our presentation. And what was we got a 1265 credit.
Okay.
We got a 13,000 margin, right?
Okay.
17,000.
Yeah. So where is the 17,000 coming from?
So this is a 100,000 account.
Okay.
and you see the resulting cash buying power is becoming 83,000.
Okay.
So we see some brokers will not give you the exactly how much buying
Got it.
power is required. So I'm doing the reverse calculation. You have
Okay.
100,000 minus this. I mean,
Okay.
some
Got it.
painful, but you have to do some. If everything is written, then it's a lot easier, right?
That's okay. Yeah.
So this is again the 25 days expiration. Now this is 32. Let's go back and change it to 32 here. So 32 days to expiration. Credit received is 1265. Buying power is 17,000. Return on capital is 7.44. If I do the same thing for annually, I'm getting 84.88. My risk is again, I'm going to keep some stop loss, meaning as soon as if the market is against me, I'm going to cut my losses and move on.
Okay. Now, could you help me with, say, for example, in that trade, if you don't sell 3, if we just sell 2, what is the margin deployment changing?
So let's
Two.
reduce to 2 here.
Yeah.
We are getting 525.
Okay.
So it is 9,000, almost like 8,000. It's something. Yeah.
Can we just change the Excel sheet?
Sure. So we got 525.
Yeah.
We got 30, same thing. We got 525 and we got like 9,000 buying power. Yeah. Our return on capital is 5.83, annually 66. It's still amazing. I mean, but again, when the trade is, not everything might work in our favor, but when you do all of these things together, if some things are getting stopped out, something else will make money. That's how your the 25% CAGR comes into picture.
Okay. No, I was asking this question from a perspective, how do I decide, is it going to be 1:2, 1:3, 1:4, 1:10? There has to be some method, right, where I decide 1:3 is an ideal number.
Yeah, ideally, in a trades like this, 1:1 is ideal because your stock, but again, you don't get your risk reward becomes like 1:1 because basically the max loss will be 500, the max gain is $2.80, like a 280, right? Yeah. So I tweaked by doing more on the call side because I know for a fact historically that this stock will not go up like 2% within the 1 month time frame because historically, let's say if I take like 80 months, right, this happened like twice. Okay. So I would keep those things in mind, and my only goal is to get more premium, no matter with keeping the same risk in control. Okay, fair enough. I understand now. Yeah. So and now we spoke about put selling. And call side is also opposite side. Now, what will you do when the market is kind of a neutral, meaning it going in the range bound, like it doesn't do much. Like some of the times you can sense it. When I say sense it, right? Let's say there are no events scheduled, like president is not appearing, there is no FOMC event, there is nothing, right? And you can gauge that there are no news that are CPI, PPI reports are coming. None of those things are true. Then you can gauge that market is maybe in the neutral zone, right? What you can do is you can sell strangles. Okay. Now strangles are, I'm doing the same thing QQQ. Strangles are, you're going to go 30 delta to the put side. Okay. And you will also sell 30 delta to the call side. Why? Now I want to go back.
Why you have 30 delta in your mind every time you start something?
Yeah. When we did the back testing, the 30 delta was very prominent within the 30 days time frame. Okay. If I'm going like a 45 days or a 90 days, that's when the 15 delta comes into picture because the theta decay happens from the 45 days to the heavily happens from the 45 days to expiration. So when we are doing within the 30 days, so we have to go like 30 delta. Back testing showed that, right? And I want to go back to the call selling side. If you asked me, when do I select, and if there was any kind of a margin buying power, like if it increases or decreases, right? So this was the thing, right? I mean, let's say if it's too much, meaning you don't have a lot of buying power to do this kind of a trade. Okay. I can go far out of the money, like let's say 700, and I'll buy one more call here, like maybe 2 more calls. So this becomes 1:3 ratio. Okay. Now my buying power will be even lesser. If you remember the 17,000, right? I mean, it came back to 11 now. Okay.
Okay.
89. So this one I forgot to mention. So within the same, when the market is going to go down, you have to do some kind of a ratio spread, right? Now, when the market is in the neutral, we have to do like a 30 delta strangles. So strangles are you are selling a call and you are selling a put.
Okay.
So that's this, and the 30 delta is somewhere here. So what would happen is right now this stock like a QQQ is trading at 626.
Mm-hmm.
If it stays between 609 and 641,
Mm-hmm.
you will get to keep this 1456 credit to yourself.
Okay.
Right, and that's it. I mean, these are all based on some kind of a assumption, meaning market is going to be neutral and within the range bound, right? Now again, as I said, right, we'll always have some kind of a stop. For this again, I will keep either I want to make $1,456 or have a loss of 2,800 because if the market trends, let's say heavily downside, for example, right, and suddenly this put side, let's say it went to 59 like a 600, for example, right, obviously this is going to be heavy loss for you. You have to cut the losses and do this again next time. You cannot be married to one position. You have to keep doing the same thing again and again. We'll have wins and losses, but as long as your wins are higher, it makes sense to continue the trade.
Okay, so what's the ROE in this case? Can we do plotting the Excel sheet?
Sure. So we only need 8,000 to do this, but we are getting 1455 credit.
Wow.
Because we are selling both sides, right? I mean, right? So let's see. Let's come back here. It's a 32 here. What is it? 32, 14, 25. Buying power is like 9,000, right?
Yeah.
8,000 something, but it's lesser than that. I mean, it's like marginal difference. So we are getting 17% return on capital, 200% return on annual, and
this is crazy. So in the US market offers more return as an option seller. Indian market doesn't offer so much. Surprisingly.
Yes, and I always say this also. Only if this was this simple. Meaning, these are amazing. But the question remains is, how do you respond when a trade is against you?
Yeah.
That's where the whole, the calmness, the beauty comes into picture, right?
Yeah.
I have done every strategy, every single thing that is possible out there. And I figured it out. Figured in the sense, I have my go-to strategies that I do every single day again and again, because I know those probabilities, right?
Yeah.
So we have highlighted some of these strategies so that people can understand and they can think of what to do, kind of a thing.
Mm-hmm.
And I can still continue. There are two more strategies that I want to talk, and then we can wrap it up probably.
Sure, absolutely.
Right. So let's say you have no idea about what the market is doing. Meaning, I'm not a technical guy. Meaning, I don't read the charts. I only look at the charts. There are no indicators to be used. I don't look at any of those things, right?
Okay.
Now, what would I do if I don't know anything, right? There are two things which are pretty amazing, like a poor man's covered calls and rolling put diagonals. Now, as the name sounds, covered calls, everybody must have heard it. You have a stock, you are selling a call against it, and your goal is to capture the call premium and do this again and again. That's a covered call strategy. Now, poor man covered calls is what you will do is you will go back, let's say, in an Indian perspective, Indian market perspective, because we don't have more than 30 days, I'm going to do like a 32 perspective, right? So what we will do is, again, I'm using the same QQQ example. I'm going to buy a 70 delta call. So basically that's nothing, but this is a 70 delta call. To buy this, I need to pay $1,880.
Okay.
I bought it. Okay. Now I bought it. Now I hold the QQQ 619 strike call. Now my goal is come back to the shorter time frame. Let's say that expires tomorrow, December 9th. What I will do is my goal is to earn this $1,880 by selling on the call side. I
Okay.
can do it on the naked call set. So if I do the 626, I will get $276, and this doesn't require a lot of margin because the long is holding the lot of value. Like a 619 is because it's like almost like a stock option. You are able to sell covered call. Now at the end of this session, your only goal is to see where is this stock trading. Is it pierced through 626, or did it go down below like 1 or 2 points? If
Okay.
it goes below, then you get to keep the 200. You come back and you do the same thing again the following day.
Okay.
Because in the 30 days we paid $1,800 as a premium. My goal is to earn more than that, so that it makes life easy, because this is like a active kind of a strategy, day in day out. You have to continuously do it.
Just one, maybe I missed it. I don't know. With the 626 strike, you calculated it on the basis of 70 data?
No,
619,
I
619 was 70 delta, which you bought.
70. Yes.
70. And what about the
Correct.
626?
626 at the selling, it's at the money. So basically we are near
At
the
the money.
50.
Okay. At the
We
money.
are at the money, and assumption is like market is gonna obviously, like, I mean, it will not pierce through every single time. The
Okay.
goal is to keep this premium and continue to the next day. If
Okay.
it pierces through, not a big deal. You close that for a loss, and because if this goes to a loss, the long call will have a huge premium for you.
Yeah. Got it.
Because if it is moving up, 619 will be more premium, and
Yeah.
626 will have a, because we are doing like some kind of a calendar kind of a thing.
Yeah.
But this is like a poor man's covered call.
Yeah. Got it.
Now you do the exactly same thing on the put side too, meaning, so that's a rolling put diagonal. So what you
Okay.
will do is you will come back here, and for the January 2nd, you will buy some sort of a the put here. For the put, at 627, it is costing 1190, and your goal is to consistently sell, come back to the next day and sell one more put here at the money. And you do this every single day. And at the end of the session, you have to make sure that you are closing this strike, so that if it pierces through, right, because this will be a somewhat loss, but again, the January 2nd 627 put will have a more premium left over.
Okay.
You do this like a cycle. Yeah. And this is the the value added monthly index for the fund, actually, meaning I started the fund in June 27. As you can see, the curve doesn't have a lot of volatility. Like, we don't have ups and downs. Like, it just tries to make continuous money steadily, in and out. I mean, all the strategies are a little different, but this is still October. This was my personal I showed this to you. I mean, you had to vet through, obviously.
Yeah.
So that was my last 3 years, and I call this as the most successful account because as you can see, the orange line is the S&P 500, where you can see there are a lot of dips that came through even this year as well. But again, my portfolio is continuously steadily is going up.
Amazing. Naresh, long-term wealth creation using options. What a beautiful topic. And the way you've explained, you are a naturally gifted teacher, I must say.
Thank you, sir. That's a honor.
No, seriously, I mean, the way you have designed a model for yourself, and I'm sure you are also helping other people to learn this. But I wish you best of luck for your fund. This outperformance is actually quite impressive. So right now, how much money do you manage in your fund?
10 million, including my own money.
Okay. And the fund is based out of US. Obviously, it trades in US market, right?
Yes, sir. So I mean, if you Google, you will get all the Form D filings and SEC, FINRA. A lot of people will have a feeling, oh, Naresh, how are you different from Kathy Woods? I'm like, we are not different. Kathy Woods has a bigger money.
Yeah.
I'm not there yet. Maybe I'll reach one day.
Yeah. Amazing. And have you tried Indian market? Are you trying Indian market also? No.
I have never traded a stock. I'm 47, sir. By the way, I'm born in 79. I just want to. I try to gauge. I think we are the same age group. I'm
exactly
unsure.
The same. Exactly the same.
Yeah. So because I was trying to find out. I mean, so I left India like 2001, right? I mean 24 years. I'm in the US. I'm a US citizen right now, and my kids are born and brought up here, and we still have some assets back home, but I never traded India market. I mean,
Okay. Okay.
yeah, but loved your content. I mean, loved your content, and because I'm a learner, as a visual learner, I love to see what others are doing.
Yeah.
That's why I stumbled upon to your channel. It was not a short format, which is amazing. It's like a movie, like episodes like a movie.
Yeah.
I so I love those things. I mean, good to talk to everyone. I mean,
Thank you so much, Naresh. You have really make all of us proud, and by giving this learning content, I'm sure you have added value to your country, which obviously I'm sure you guys also feel some time that yes, you want to give back to the country in some way. So this is your way of giving back to the country. Thank you.
yes, thank you, sir. Thank you for the opportunity, and please keep in touch.
Yes, absolutely. We'll be in touch. And all my learners who stayed till the end, thank you so much for respecting the content and staying till the end, because the real essence is when you stay till the end and start practicing what Naresh has taught us. I'm sure you will be able to generate some additional alpha in your market. Thank you so much. Bye. Take care. And Jai Hind.
Thank you, guys. Yeah. Bye bye.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.